Here's a question nobody ever puts on your calendar. What happens to your 401k the day you turn 73? Not the birthday card. The other thing, the day the IRS quietly reclassifies every pre-tax dollar you've ever put into that account and starts requiring you to take it back out, whether you need the money or not. There's no letter that arrives early to warn you. No calendar invite. Just a hard deadline that switches on the day you turn 73, and a penalty waiting for the first person who doesn't know it's coming. Here's the myth on both sides, and both sides are wrong. Some of you think this only matters if you're barely scraping by. Others think it's a rich person's problem, something only people with 7 figures need to think about. Neither is true. If you have $500,000 or more sitting in a traditional 401k or IRA right now, this rule finds you no matter which camp you thought you were in. And this is a pattern I watch play out again and again with people who did everything right for 30 years and never once heard this explained. What I'm about to walk you through in the next 10 minutes is the answer to that first question: what actually happens at 73, plus the 4 moves that decide whether you hand a fortune to the IRS or you never let it get that far. If you have $500,000 or more in a qualifying account, stay with me. The answer is coming in about 90 seconds, and it's the reason I made this video. Let's answer that first question, because most people have never had it explained clearly. The rule is called the Required Minimum Distribution, the RMD, and it isn't a suggestion, it's a federal mandate. Starting the year you turn 73, the IRS tells you how much you must pull out of your traditional 401k or IRA every single year, whether you need the money or not. They decide the amount, they decide the schedule, and every dollar that comes out gets taxed as ordinary income stacked on top of whatever else you're earning that year: Social Security, a pension, investment income, all of it. Miss it, and the penalty is steep. If 25% of the amount you should have withdrawn, cut to 10% if corrected quickly. That's the IRS, taking a quarter of the number you got wrong. Here's what that looks like in real numbers. Say you have $1 million in a traditional IRA at age 73. Your first RMD is roughly $37,700. That amount lands on top of your Social Security and pension income, and suddenly your tax bracket is higher than you planned. That $37,700 isn't the whole bill either. There's a second number waiting behind it, hundreds of dollars a month, and it never shows up on the RMD statement itself. Cross certain income thresholds, and Medicare's IRMAA surcharge adds another layer on top. For a married couple, that can mean paying hundreds of dollars more per month, per spouse, for the exact same Medicare coverage everyone else gets at the base rate. Up to 85% of your Social Security can become taxable too. The RMD doesn't just cost you the tax on the withdrawal. It can quietly raise the price of your health care in the same year. The RMD freight train is coming. Are you on the tracks? If you have $500,000 or more in a qualified account right now, you're standing exactly where millions of retirees stood before they understood what deferred really meant. The QCD, give it away tax-free. Here's a question that flips this entirely. What if you could hand some of that account to someone else, and the IRS never touched a dollar of tax on it? It's called a Qualified Charitable Distribution, a QCD, and almost nobody uses it because almost nobody explains it. Once you're 70 and a half or older, you can send money directly from your IRA to a qualified charity, up to $105,000 a year, and that amount counts toward your RMD without ever showing up as taxable income. Not reduced, not offset, never counted at all. For someone who's charitably minded anyway, this is close to free money. You are going to give, you are going to owe the RMD, and this move lets one satisfy the other. But it only works for the portion you're comfortable giving away. For the rest of the account, you need a different lever. If this is landing for you, if you're realizing your own 401k has the same silent deadline mine did, hit subscribe. I release a new video every day, 5 days a week, and what's coming next makes this one look like the warm-up. The Pre-RMD Roth ladder. Here's the part that matters, even if you're not the giving type. What if you could take money out of that account, pay tax on your own terms, and then never let the IRS touch it again? That's the Pre-RMD Roth ladder, and it works because of a simple mathematical reality. The tax rate you pay today is almost always lower than the rate the RMD will force on you at 73. Every year between now and then, you convert a controlled portion of your traditional IRA into a Roth IRA. You choose the amount, you choose the bracket, you pay the tax now at a rate you control, and that money is permanently removed from the IRS's mandatory withdrawal system. No RMDs on a Roth. Ever. It grows tax-free, and it comes out tax-free for the rest of your life. Couples who act between 62 and 70, before Social Security, before Medicare surcharges start stacking up, can often convert $50,000 to $80,000 a year inside a 22% to 24% bracket. That's dramatically cheaper than the 32% or higher they'd pay on forced RMDs a decade later when every income source is running at once. The protected tax-free container. Here's the piece almost nobody puts together. What happens to the money that doesn't fit inside a Roth conversion? The overflow the IRS limits you from converting each year. The answer is a properly structured indexed universal life policy, an IUL, a protected tax-free container built under IRS tax code, section 7702. Here's something most people never hear. The cash value inside a properly structured IUL is classified as a Tier 1 asset, the same category banks use for cash and U.S. Treasury bonds. Banks hold billions of dollars in life insurance cash value on their own balance sheets. They call it BOLI, bank-owned life insurance. If it's good enough for JP Morgan Chase and Bank of America, it's worth 30 minutes of your time to understand why. The money inside grows linked to a market index. If the market goes up, you participate in the gain. If the market goes down, there's a floor. You don't lose principal from that downturn. And when you access the money through policy loans, the IRS doesn't classify those loans as income. No 1099, no tax event, no RMD requirement ever on that piece of the plan. It doesn't replace the Roth ladder or the QCD. It's where the overflow goes once those two are maxed out for the year, so none of your plan is left waiting on the sidelines with no home. The surviving spouse trap. Here's one more question worth asking now. While both of you are here to hear it, what happens to these RMDs the day one spouse passes away? The rules don't get gentler, they get harder. A surviving spouse who inherits the account often has to keep taking RMDs on their own, now filing as a single taxpayer with a smaller standard deduction, while the account balance hasn't shrunk at all. The same withdrawal that felt manageable filed jointly can suddenly stack differently against a single bracket. It's not a rule anyone plans around because nobody wants to think about it. But the couples who build the Roth ladder and the protected tax-free container years in advance hand their surviving spouse a bill that's already been shrunk instead of one that grows the day grief starts. Here's how this played out for a real client. I'll call him Randy, a physician in Texas, because the details of his situation are anonymized, but the numbers are real. Randy was 71, net worth north of $3.5 million, with $1.37 million sitting in qualified retirement accounts and RMDs about to start in under 2 years. Nobody had ever walked him through the pre-RMD window. His advisor had him parked in a real estate fund position he couldn't easily unwind, and that illiquidity meant his RMD would have to come out of the one account he could actually access at exactly the wrong time. We restructured it. 2 years of controlled Roth conversions inside a bracket he chose on purpose. A QCD carved out for the charitable giving he was already doing anyway. The overflow redirected into a properly structured IUL. By the time his first RMD came due, the number had dropped meaningfully instead of exploding, and his Medicare premium stayed at the base rate. Same accounts, same 30 years of saving, a different order, and a dramatically smaller tax bill for the rest of his life. 4 moves, 1 window, draw from the flexible bucket on your terms. Give what you already intended to give through a QCD. Convert what you can into a Roth before the door closes. Protect the overflow somewhere the IRS can never reach it again. None of this is a guess. It's math, run against your specific numbers, at your specific age, done properly. Here's your mirror moment. If you have $500,000 or more sitting in a traditional 401k or IRA, and nobody has ever walked you through the QCD, the Pre-RMD Roth ladder, or the protected tax-free container, you're exactly where Randy was before we ran his numbers. Not because you did anything wrong, not because you weren't paying attention, because nobody ever sends a letter before the day you turn 73, and the form you filled out at open enrollment never mentioned any of this. Most advisors are trained to help you accumulate. Almost none of them are trained to help you get the money back out without the IRS taking the biggest possible bite. The right sequence isn't a product you buy, it's a decision made in the years before 73, before the buckets all switch on at once and the choice gets made for you instead. This isn't a one-size-fits-all answer, and it never will be. Randy's numbers aren't your numbers, and the mix of QCD, Roth conversion, and protected tax-free container that fits your account depends entirely on your own age, balance, and goals. Below this video is a link. Book a time. We'll look at your specific numbers, your balances, your age, your Social Security timing, your health, your spending needs, and show you exactly how much of that future tax bill we can legally reduce before the window closes. You spent 30 years building this account. Spend 30 minutes deciding how small a piece the IRS actually gets of it. Rescue, reclaim, retire richer.